Welcome to the Explainer. Today, we are digging into gold's incredible record-breaking surge. We're going to uncover why the old rulebook for this timeless investment, well, it just doesn't apply anymore, and what all that means for your portfolio.
So gold recently just smashed through its all-time high, blowing past $4,040 an ounce. But, this isn't just another rally. The reasons this is happening are fundamentally different, and it signals a huge shift in how the world's biggest players are thinking about money and risk.
And its power is just undeniable. I mean, look at this. During the 7 biggest market crises since 2007, gold didn't just hang in there, it absolutely thrived. It delivered an average return of over 26% while the stock market was actually losing money. So yeah, it's proven to be way more than just a place to hide. And that brings us to the most important question, right? The old playbook, the one that said, buy gold when inflation is high, well, it's starting to look obsolete. So if that's not the main story anymore, what on earth is pushing gold to these historic levels?
Okay, let's really get into it. We've got to understand gold's new job, its evolved role in a modern portfolio, because its whole identity has basically been rewritten.
A lot of experts are now arguing that gold's main purpose isn't just to beat inflation anymore. No, it's to act as a systemic risk hedge. Think of it like this. It's not insurance for your house, it's insurance for the entire global financial system when it starts to crack.
And this right here really nails the core idea. The conversation has completely shifted. It's moved away from just protecting your spending power to, actually insuring your portfolio against really deep structural problems in the global economy.
So who's behind this massive identity shift? Well, I can tell you, it's not your average investor. The new whales in the gold market, they're playing a completely different game.
Now, at a quick glance, this chart might look pretty normal. Jewelry makes up about half of all gold demand, right? But here's the twist. During these huge price rallies, that jewelry slice, it's not what's moving the needle. All the action is happening in that 40% investment slice. In fact, there's actually an inverse relationship here, which is fascinating. When gold prices skyrocket, demand for jewelry tends to fall off. What does that tell us? It means these historic surges are being fueled almost 100% by investors who are running for a safe haven.
And who are the biggest of these big investors? Central banks. Just look at this jump. I mean, it's incredible. They've gone from buying about 450 tons a year to well over 1,000 tons. They're buying gold at a pace we have never seen before.
And their reasons are purely strategic. Yeah, they're hedging against global risk, sure, but they're also looking for financial independence, a way to operate outside the traditional banking system. And critically, they're actively trying to reduce their reliance on the US dollar. It's a trend people are calling de-dollarization. And this is the end result. All of this massive, consistent buying from institutions that don't really care about the daily price, it creates a super strong floor under the price of gold. It's like a safety net that gives all the other investors a ton of confidence. Okay, so that's the why. Now let's talk about the how. If you're an individual investor and you're thinking about getting some exposure to gold, what are your actual options? Let's break them down. When you're deciding how to invest, there are always trade-offs. Physical gold is great because you can hold it, but then you have storage costs, and it's not so easy to sell quickly. Gold ETFs, on the other hand, trade just like a stock, but you don't actually own the metal. But honestly, the most critical detail, the one almost everyone misses, is right there in that last row, taxes. So, in the United States, the IRS often treats physical gold and many of the funds that own it as collectibles. This means your long-term capital gains can be taxed at a much higher 28% rate. Compare that to the 20% max rate for stocks. That difference can take a huge bite out of your final return. Now, for anyone investing internationally, where you store your gold really matters. A place like Singapore has become this major global hub. Why? Well, it offers tax-free status on investment-grade metals, it's politically stable, and it's got rock-solid security. It's really no surprise that storage requests there have just surged. But of course, let's be realistic, no investment comes without risk. So let's take a balanced look at how gold actually fits into a practical strategy, keeping a very clear eye on the potential downsides. Gold is not some magic bullet. First off, it can be really volatile in the short term. Second, if real interest rates go up significantly, holding an asset like gold that doesn't pay you anything becomes a lot less attractive. And finally, if global tensions were to suddenly calm down, that safe haven demand could dry up pretty fast.
So keeping all those risks in mind, most financial experts don't recommend you go all in. Instead, they suggest a disciplined, strategic allocation, something in the neighborhood of 5 to 15% of your portfolio, and you should really think of it as a form of long-term insurance.
So, the big takeaway here is to be strategic. First, see gold for what it truly is. It's portfolio insurance, not your main growth engine. Second, with prices at record highs, maybe consider buying in gradually to average out your entry price. And third, be really deliberate about choosing the right investment vehicle that makes sense for your costs, liquidity needs, and tax situation. Ultimately, I think this quote just perfectly sums up gold's modern purpose. It's not about trying to get rich quick. It's about having an anchor of stability when the rest of the market feels like it's in a storm.
Which really just leaves us with one final thought to chew on. In a world that seems to be getting more divided and more uncertain by the day, is holding gold in your portfolio shifting from simply being a tactical choice to becoming a strategic necessity?